The following analysis is for educational purposes only and does not constitute investment advice. Past performance and historical compounding do not guarantee future earnings. Danaher has spent decades earning a reputation as one of the public market's most reliable and precise compounders of capital. Yet, despite that established pedigree, the company is currently trading at a steep discount to its own historical averages. The engine has stalled. Danaher is executing a massive structural pivot from industrial manufacturing into life sciences. This transition is generating severe operational friction across the portfolio. The critical question for 2026 is whether this friction represents a temporary cyclical trough or the permanent destruction of the company's compounder premium. If the market is currently mispricing a temporary period of corporate adaptation, this discount represents a rare, fundamental entry point for institutional capital. During Phase 1 of its evolution, from 2000 to 2018, Danaher operated as a serial acquirer, absorbing over 400 fragmented industrial businesses. The defining feature of this period was a highly decentralized operational model. Acquired targets were allowed to maintain their local leadership and internal autonomy. By applying disciplined capital allocation to fragmented, niche industrial markets at reasonable multiples, Danaher engineered consistent returns on invested capital. That model was abandoned in Phase 2. From 2019 to present, Danaher executed a hard pivot into life sciences, deploying roughly $47 billion. The sheer scale of this deployment is evident in the targets: a $21 billion acquisition of GE Biopharma, $9.6 billion for Alderaan, and $5.7 billion for Abcam. Management executed these massive purchases as a structural, long-term bet on the secular growth trend of modern biologics. But the pivot introduced immediate internal friction. Danaher replaced its historically decentralized approach with aggressive, highly centralized integration. At Abcam, local leadership was replaced, and rigid internal systems were imposed. The integration process actively degraded the target company's existing digital capabilities. By shifting from buying predictable, fragmented factories to acquiring highly concentrated, volatile science companies, Danaher permanently altered its risk profile and multiplied its execution burden. The engine of Danaher's historical value creation is the Danaher Business System, or DBS. This operational philosophy is effectively the Toyota production system, translated and adapted for the realities of American manufacturing. It worked flawlessly during Phase 1 because it was applied to traditional industrial operations, where factory efficiency and waste reduction are the primary metrics. The realities of the Phase 2 life sciences acquisitions offer a stark contrast to those industrial assembly lines. At Alderaan, the manufacturing processes are so complex and highly customized that applying standard, rigid DBS efficiency tools proved nearly impossible. Reports from multiple ex-employees reveal a significant qualitative and cultural shift occurring across these newly acquired science segments. In these environments, DBS is no longer viewed by operational teams as a dynamic, responsive problem-solving tool. Instead, it has morphed into a dogmatic mechanism of internal control. It functions as a rigid box-checking exercise prioritized by management. The downstream impact heavily restricts research and development. The strict nature of the system dictates highly incremental work, and employees are not rewarded for taking the risks necessary to drive actual innovation. If the DBS engine cannot adapt to nurture scientific talent and R&D, the operational system that built Danaher's moat will actively destroy the value of its $47 billion investments. Beyond the internal integration struggles, we have to map the macro demand environment, specifically within biotechnology, the portfolio's core revenue engine. This chart displays bioprocessing quarterly revenue. Notice the massive post-pandemic destocking cycle that battered the sector starting in 2023. Year-over-year growth bottomed out at negative 21% in the fourth quarter. While that severe destocking phase has finally concluded, it has left behind a highly bifurcated two-speed recovery. The first speed is driven by consumables, the essential filters, resins, and bags required for daily laboratory operations. Continuing on this graph, the resumption of commercial monoclonal antibody production has pushed consumables back to high single-digit and low double-digit growth, reaching positive 9% by late 2025. The second speed, equipment, tells an entirely different and much weaker story. Equipment orders remain severely muted. Faced with policy uncertainty, biopharma companies are choosing to optimize existing capacity rather than commit capital to building new facilities. Unlocking a true equipment growth cycle requires a specific catalyst: the execution of the $405 billion pledged for United States pharmaceutical onshoring. Danaher's ability to hit its target of 3 to 6% organic growth for 2026 relies almost entirely on this equipment capex cycle materializing to match the recovery we already see in consumables. Connecting this operational friction and macro uncertainty to the financial scorecard reveals how management is actively defending the company. In fiscal year 2025, Danaher posted $24.6 billion in total revenue. This marks the first year of positive top-line growth since the peak in 2022. Notice this chart's abrupt shift. The M&A pipeline completely dried up in 2024 and 2025. In response, management initiated their first-ever share buyback program. The magnitude is massive, deploying $9 billion into buybacks over 2 years. Even with operating margins compressing during this transition, the underlying business remains an elite cash generator, converting over 140% of its adjusted net income directly into free cash flow. This forward PE graph shows the market digesting this transition. Look at the sharp decline. The company is currently trading at 21.4 times earnings. The gap below the 5-year historical average dotted line represents a severe 17% discount. The market is currently pricing Danaher as if its life sciences integration issues and DBS frictions are permanent. But if management proves they can execute in 2026 and the biomanufacturing equipment cycle turns, this 17% discount represents a rare, structural mispricing of a premier global compounder.